sole proprietorship business, we have the partnership business, and then we have the limited liability company business. So far, Mr. Hagan has taken us through the sole proprietorship business, and I will be dealing with the partnership business. Once I'm done, we will turn our attention to the limited liability business. I think partnership will be very interesting and very easy for most of us, because I think the profession that we are seeking to be in has the partnership concept of businesses. I.e., when you look at the law firms, of course, we've got the chamber concept and other concept, but also quite a number of the law businesses are partnership firms, right? So this will be more relevant to us. We'll find ourselves in these kind of situations post graduation and post being called to the bar. Now, what is a partnership? Okay, I will try as much as possible to explain or deal with the theory aspect of it. One of the things I noticed when you look at the past questions is that they like a mix of theory and calculation. So let's not take our attention away from the theory aspect of the exams. I can tell you that if you have a partnership question, from what I have seen, 40% of the question is likely to be, or 40% of the marks is likely to be theory, and the remaining 60% being the arithmetic or the calculation or the accounts preparation. Okay, so the theory is very, very important. Okay, so let's start. What's the partnership? Our reference is going to be the Incorporated Private Partnership Act of 1962, Act 152. Okay, that's a very old law. The law is still valid. It hasn't been repealed. So that's the law we are going to be making use of. Together with that law is the LI 2423. Okay, LI 2423 also has provisions regarding the keeping of accounts. Okay, so these two laws are the most relevant for us as far as partnership is concerned. Apart from the definition of partnership, we will tend to more specifically from section 30 to section 37 of the Partnership Act, Act 152. That's where a lot of the things we will talk about will be coming from. Okay, so what's a partnership? Who can help? What's a partnership? There are certain key things that you need to have in your definition of a partnership, right? You don't need to memorize. But there are, I think, 4 key things that must appear in your definition of a partnership. And if you have those things, you are likely to get the full marks. What's a partnership? Who can help us?
One of the key things is membership of 2 to 50 persons.
Okay, so our big brother here talks of membership of 2 to 20. 20 persons, yeah? What else? So let's put the key elements that we can define it, yeah? Jointly and severally liable. Okay. Who else? It's an association. And there must be business being carried on jointly. Okay, so it's an association. There must be business being carried on jointly. The purpose of the business must be for profit. Okay, so having these key elements, if I'm to define what a partnership is, I will say a partnership is an association of not less than 2 people but not more than 20 people, carrying on business jointly for the purpose of making profit. Okay? And when you turn to the Partnership Act, you will find this definition there, right? So it's important that it should not be more than 20 people, and they should not be less than 2. And it's important that they must carry on business jointly. And the purpose of the adventure must be for profit. Are we good? Okay. All right. Having defined what a partnership is, the law goes on to identify certain associations or relationships that mimic that of a partnership, but for which the law doesn't recognize as a partnership. Okay? So it's important we also know this, right? Because if the examiner asks what's a partnership, or he will say, under the law, what are some of the associations that though may resemble a partnership, the law doesn't deem as a partnership. Okay, so what are some of these associations? Anybody? So one of such is, the law specifically says that if a person is in one's employ, and that person, for the purpose of remunerating him or her, is entitled to a certain percentage of the profit, that remuneration which is tied to profit does not necessarily make the person a partner. Okay, so for example, I may be employed by ABC Limited, and for the purpose of motivating me to perform well, the company may say, at the end of the year, they will pay me 10% of the profit of the business as bonus, meaning every year I'll be entitled to share in the profit. The law says the mere fact that I'm allowed to share in the profit does not necessarily make me a partner. Does not mean I'm in partnership with the owners of the business. Okay? The other thing the law also says is that a body corporate cannot be a partner in a partnership firm. So when we're talking of an association of persons, artificial persons are excluded from this association. Are we okay? All right. So body corporates are excluded. Body corporate formed under the laws of a foreign entity are also excluded. Okay. And then finally, joint ventures without firm names are also excluded. So far, what have we studied? We've defined what a partnership is. We've explained what a partnership is. We've gone further to identify the exceptions of entities that mimic the appearance of a partnership, but for which the law does not recognize as a partnership. Okay. Have any of us seen the supplementary exams? The question on solicitor's account. That 25-mark question, I promise you, was like 100% theory. So much as we know, I know a lot of us are uncomfortable with accounting, let's not pay too much attention to the arithmetic. Let's not over-respect the arithmetic. The theory is very important. I mean, because if you know that theory, you could score 25 over 25 for that question. Basically, they were asking us to reproduce rule 27, or is it rule 27 or rule 25 of LI 2423. There are 7 sub-rules under that rule regarding the types of accounts that has to be prepared by a firm. Okay? And then the question B was asking that what are the 5 types of accounts that a firm must prepare for a law firm, right? The solicitor's account. What are the 5 types of accounts? So there was no arithmetic whatsoever as far as that question was concerned. So again, partnership, they can do same. Okay? And I've seen almost all the accounting questions I have seen, there are theory like, it's not only arithmetic, there's also theory aspect. So let's pay attention to the theory aspect of it. It's important. Okay. All right. Now let me go on to talk about the partnership agreement, which is also one of the sources of questions from the examiners. They like it a lot, right? We know that the rules or the law, the Partnership Act, requires that in order for a partnership to be incorporated, the partners will have to submit, as part of the registration process, an agreement between the partners, what we call a partnership deed. Okay? The question is, what must be contained in this partnership deed? What do you think? What must be contained? Well, it could be a question. Examiner asks us to say, okay, A and B wants to start a law firm. We know under this they have to submit a partnership agreement. They've asked us to assist with drafting this. We should write what are some of the things we'll put in this partnership deed. If I say partnership deed, it's the same as the partnership agreement. Yeah, Abigail, what do you think?
So the name and addresses of the partnership,
okay,
within a specific jurisdiction and outside a specific jurisdiction.
Okay, so Abigail is saying the agreement must contain the name of the partners and the partnership firm, and the address of the firm, the address within a specific jurisdiction, meaning if the firm is supposed to be here, then they must show the name, and if they have an office somewhere else, they must show that address as well. What else? Charlie, there's something that means to be the first thing I'll write to. Yes.
The object.
Okay, the object of the firm. Okay, what is the partnership going to be engaging in? What will be, for what purpose are they being established?
Making profit. Making profit.
Yeah, that's the underlining reason, making profit. But the object may be to provide legal services, for example, or if it's an accounting firm, to provide accounting and advisory services, right? So that could be the object. What else? Yes?
So the name of the partners, their residential addresses, and their business occupation and addresses.
Okay, 100%, right? Name of partners, their business address, their occupational addresses, right? What else? Capital contribution. What will be the capital contribution of the partners? How is profit going to be shared? Profit sharing ratio. How is profit going to be shared? Must be contained in the partnership deed. What will happen if a new partner is to be admitted? The rules regarding admission of new partners, rules regarding resignation of partners. Are we going to pay interest on capital or not? And if yes, how much? Are we going to charge interest on drawings? And if yes, how much? Profit sharing ratio, right? So these are things that has to be agreed on in the partnership deed or in the partnership agreement. However, the question is, what will happen if the partners do not have these specific provisions in the partnership agreement? So there is a partnership agreement. They've entered into a partnership agreement because the law requires that there be a partnership agreement, and it forms part of the documents to be submitted for purposes of registration. So there is a partnership agreement. However, the partners forgot to include certain specific provisions. For example, how profit is going to be shared, how capital is going to be contributed, and those stuff. They do not include them in the partnership agreement. The question is, what will happen? So, and this is an exam question. I've seen it in one of the questions before. It says, under a circumstance where the partners have not made provision for profit sharing, for interest on capital, for interest on drawings, and so on and so forth, what happens? What does the law say? And this is all captured in the law, right? So all I'm saying is in Act 152. Okay? So to start with, the law says if the partners do not expressly state in the partnership agreement what must happen with capital, the law then says that the assumption is that the partners shall contribute to capital equally. Okay? And that means that they will share profit equally. any contribution by a partner in excess of the amount agreed shall attract an interest of 5% per annum. That's what the law says. 5% per annum. Okay? Any additional contribution in excess of the agreed capital or in excess of the equal capital contribution by any of the partners shall attract an interest of 5% per annum. Okay? So that's what the law says. Okay. Now, I think we've had enough of the theory. Any questions before I turn my attention to the calculations?
Which section of the act?
So look at from section 30 to section 37 of Act 152. Okay, from section 30 to section 37. So specifically, we look at section 33. Okay, it talks about the way profits are to be shared if they don't have an express agreement. You see it in 33. Okay. So now let's turn to the account preparation. Okay. So up until now, we've dealt with sole proprietorship, right? We know how to prepare the profit and loss account up to net profit of a sole proprietor, correct? So we'll build on that, okay? The good news is that the way you prepare a profit and loss account for a partnership is the same as the way you do it for a sole proprietor, except for some few variations.
It's not the same.
No, it is the same, right? So, except for some few variations, and I'll highlight those variations and I'll explain why the variation is like that. Okay. So, typically in a partnership firm, you'll find a situation where the partners are paid salaries. Okay, because I mean, they also work for the firm, right? They must pay their bills. So at the end of the month, they get salaries. You and I know that the salaries of a business is an expense of the business. Is that not it? So when we're doing sole proprietorship, we said the salaries paid must be treated as an expense before arriving at the profit. Is that not it? Okay. So this is the one exception. The salaries of the partners of the firm, and here I'm talking the partners, not anybody else. The salaries of anybody else is treated just like we do the sole trader, i.e. is treated as an expense. The only exception is that the salaries of the partners is not treated as an expense. Okay? Why? Why don't we treat the salaries of the partners as an expense? Why? Those people training to be lawyers is easy, right? Because the answer is in the law. Because section 35 of Act 152 says so. It says the salaries of the partners should not be treated as an expense. Okay. The salaries of the partners is treated as an appropriation out of profit. It's treated like the partners have come to take money from the business. Okay? So that's the first thing we must note. Okay? Then the interest on drawings. I'm trying to highlight the exceptions, okay, before we even start. You will agree with me that under a sole trader, when the sole trader lends money to any employee and charges an interest, the interest so charged is treated as an income. Okay? So when you get your gross profit under the sole trader, you add other incomes, amongst which includes discount received, interest income, or any other income that you receive, profit on disposal, and so on and so forth, right? Now, under the partnership, the interest we charge a partner for coming to withdraw money is not treated as an income. It's treated as an appropriation, just like we would treat the salaries, okay? Same applies to interest on capital. And the whole idea is that the partners are into the partnership arrangement for purposes of making profit. And whatever profit they make, they will share amongst themselves in the ratio that they have agreed to share the profit, right? So if we allow one person to keep coming and taking money without charging that person an interest, that person will be over-benefiting, right? So when you come to take money from the business, we will charge you an interest. They will treat that interest we charge you as part of the income of the business that all of us must share. Does it make sense? So I'll take it again. Okay. So I'm saying that as a partnership firm, or the reason we go into partnership per the definition is to make profit. Okay, one of the key elements we said is profit. There must be profit behind the partnership. Okay. Now we also said that the partnership deed must contain a clause that says how the partners are going to share profit. Failure which we say section 35 says they must share profit equally. Now I'm saying that if we allow a partner to come and withdraw money from the business, let's say 10,000. Remember that 10,000, we could have put that 10,000 in a bank account and earn an interest on it. So because he came to take that 10,000, we are deprived the opportunity of putting that 10,000 in the bank to earn an interest. So we will charge him an interest for coming to withdraw that money. Are we okay at this point? The amount we charge him should form part of the profit of the business that all the partners are going to share. So assuming the business made a profit of 20,000 and one of the partners came to withdraw 100,000 during the year and we charge him a profit of, let's say, 10% on the 100,000, which is 10,000. We need to add that 10,000 to the profit of 20,000 and get 30,000, and that should be the profit that the partners should share. Are we okay? So what I'm saying is, if we earn an interest from a partner, it must be added to the profit for all partners to share. In the same vein, if we pay a partner interest on the capital he or she has contributed, then before we arrive at the profit of the partnership firm, properly so called, we should deduct that interest that we are going to pay on the capital. And that interest must be treated as an appropriation of profit. Okay. The whole reason is that if you don't, the partners are likely to manipulate the profit by their capital contribution. Remember that one of the distinctions between a partnership and a limited liability company is that the profit of the partnership is assessed on the partners. Okay, so for tax purposes, the profit of the partnership is assessed on the partners. Whereas in a limited liability company, the profit of the company is assessed on the company itself. Okay, so we need, because of that distinction, we need to make sure that the partners don't take undue advantage of their capital just to siphon money out of the business. Okay, all right. Having explained this, let's proceed to now looking at the format. How does account look? What do we do? What is the nature of the accounts of partnership firms? Yes? Okay. Okay. So remember, and here I think with our civil procedure in mind, right, we can be able to understand this clearly, right? So remember, for example, when in civil procedure, one of the things we learn when we're learning about parties, when it comes to partnership, is that for a writ of summons against a partnership firm, you can either sue the firm in its own name, or you can sue the partners. Is that not it? You can sue the partners themselves. And we even learned that when you sue the firm in its own name, service of the writ on a partner constitutes service on the firm. Okay? Why? Why? Because the partners are treated as equal to the firm. Okay? So the firm itself will not pay taxes, because whatever profit the firm makes will be distributed to the partners, and then the partners will pay taxes individually on their respective shares. Do we understand? So in the company, if the company makes a profit of 100,000, the corporate income tax rate in this country is 25%. We'll slap 25% on that 100,000, and the company must pay a tax of 25,000. Do we understand? In a partnership firm, if the partnership makes a profit of 100,000, all other things being equal, the government cannot take 25% of that. That 100,000 will be shared among the partners. Let's say Cindy and her, Kukwa, right, are in partnership. Assuming that they did not state in their partnership agreement how they will share profit. The law says if they don't, it's 50-50. So that 100,000 will be shared between the two of them. Cindy will get 50,000, Kukwa will get 50,000. Then Cindy will be taxed on the 50,000 she has received, according to the tax table, because she is an individual. The tax rate for individuals is according to the tax table. So there is a whole tax table for calculating it. You don't have to, this is not a tax class, you don't have to worry your head with that. But I'm just trying to explain the distinction between a partnership and a limited liability company. Okay. Because we need to understand this, because if we do, it helps us to understand why we prepare the appropriation account the way we do. Okay. So let's turn to the format, right? So I said everything for the sole proprietor is the same as partnership, except the few exceptions I've given you. Are we okay? Right. So we would have prepared, maybe again, let me just say that anyway, it's fine. So you will have done your profit and loss account, okay? Profit or loss account, where you have your revenue, okay, whatever it is, let's say 1,000. You would have taken your cost of sales, less cost of sales out. Let's say your cost of sales is only 200 cedis. You would have had your gross profit of this. So far, nothing has changed. Same as sole proprietorship. Okay, same as sole proprietorship. So it looks like those at the back cannot see. So let me try and write it a bit bigger, right? So I'm saying you have your profit or loss account, okay, for the year ended, whatever they've given us, right? I'm trying to shorten things here. Okay, you have your revenue. Okay, your revenue, let's say 1,000. Okay, then you take cost of sales out, same as sole trader, right? Nothing is different. Cost of sales. Let's say the cost of sales is 200. So we arrive at what? 800, which is the gross profit. Okay, we all good. Sole trader, nothing is different. Then we say less expenses. Or if there were other incomes like discount received, whatever other income, interest received, we add all that, right? But I'm simplifying things because the focus is on partnership, not here. So less all expenses. Less all expenses, right? Let's say the expenses is 300. Okay. We'll get net profit. Net profit of what? 500. Right? Now, I said in deducting the expenses, one of the expenses we will not include is the salaries of the partners, right? And we explained that. Okay. So now we have this profit. So up onto this point, we are all okay. Sole proprietor, partnership, they are the same. Now the uniqueness with partnership comes from what do we do from this point? When we have the profit, what do we do from this point? That's what's unique about partnership. Okay. So once we have the profit, we are going to do a couple of things. So we will prepare what we call the appropriation account. We'll prepare appropriation account. There will, of course, be the partner's capital account. There will be, of course, depending on the question, there will be the partner's current account. Okay. You may have what you call goodwill account. Okay. There can be what we call the revaluation account. Okay. So these are the unique ones for partnership. Okay. But the profit and loss is the same. The balance sheet is the same. Okay. These ones are the unique ones. And I think that in almost like 95% of the questions I have seen on partnership, they focus here because they know when they want to assess sole trader and company, they can deal with the P&L and the balance sheet there, right? Or the statement of financial performance over there. So when it comes to partnership, then these are the unique accounts. Okay. Now, there are a few things I think I want to clarify before we continue. Regarding partners' capital account and current account, there are two approaches. Okay. There's what we call the fixed capital account approach, and there is the fluctuating capital account approach. Okay. What do we mean? And it's very simple. Either we keep a separate capital account for the partners, or we say, you know what, there's no point keeping a separate account. Let's combine both the current account and the capital account. Okay. So whenever the examiner says that for this partnership, they keep a fixed capital account, all he's saying, or what you need to focus on, is that you need to prepare a capital account separately, and you need to prepare a current account separately. Are we okay? Okay. So I'm saying there are two approaches. We have what we call the fixed capital account approach. And there's the fluctuating. Okay. Whenever the examiner says that for this particular partnership, they keep a fixed capital account, all he's saying is that under this method, have two separate accounts. Have a capital account and have a current account. Okay? So when he says fixed capital account approach, he says have a capital account and have a current account. When he says they keep a fluctuating capital, okay, when he says they keep a fluctuating capital, all he's saying is just keep the capital account. do not open a current account. All we will do, we will combine whatever needs to go into current account, we will record it in the capital account. So we'll only keep one account, and that account we will call capital account. Do we follow? So this one, all it's saying is put this together. Put these two together in one account. And that one account should be called capital account. Do we understand? The question is, why do we call it fixed capital and why do we call this fluctuating capital? Because then it will help you to remember, right? We say fixed capital because the capital amount in that account would then remain constant until further capital injection. So year on year, the amount of capital recorded in this account will remain the same. It will not change until the partners decide to inject more capital into the business. Okay? Now let me explain the fluctuating. Maybe that will make the fix more clearer. The fluctuating, therefore, then means that year on year, the capital balance will keep changing. Because remember, we said under the fluctuating capital approach, we will combine the capital account and the current account into one account that we will call capital account. And because we are combining these two, this particular account is a very fluid account. It moves a lot. This account changes a lot because this is where profit goes, this is where interest on drawing goes, this is where salary goes, this account is constantly changing. So if you are merging this account with this guy, then the balance on the total will always be changing. Do you get it? And that's why we call it fluctuating capital. So the balance on this capital account will always keep fluctuating. We good? Okay. So bear that in mind. I think a lot of the time they like the fixed capital approach, where you just keep a separate capital account and then you keep a separate current account a lot of the time. But you just never know. When the examiner will say this year I want fluctuating, let's put them together. Okay, but we'll do exercises with both. Okay. And then let's then talk about goodwill.
This, when you highlighted the partner's capital account and partner's current account,
Yes.
is it in relation to the fixed
Yes.
capital account?
Yes, because it's not always the case that you have a capital account and a current account. This will only be the case under the fixed capital account approach. But if it happens to be a fluctuating capital approach, then the two will be combined and it will be called capital account. Yeah? Okay. All right. Let's talk about goodwill. I want to talk about goodwill, talk about revaluation before I start the arithmetic. Yeah? So goodwill. What is goodwill? And why goodwill? What is goodwill and why goodwill? So let's take the law firms, right? Bella. I think, and I may be wrong, but you may also have your own view, right? But my view is that Bella, the name just Bella, has some value. So like, if it's a civil litigation, for example, and the lawyer on one side is coming from Bella, Benchienche Lechina Nkuma, right? And the other lawyer is coming from Kofi and Co, right? Without me even knowing the merits of the case, I'm likely to think that the Bella guy will win, right? Even without looking at the facts of the case, right? Because Bella has created a certain reputation, right? And that reputation has value. And I bet you, so for the two litigants, the guy who went to Bella will have to pay higher fees, right? Because there is some reputation of excellence or good, that these guys, they always win or they will win, right? So that intrinsic value in the firm we do not ordinarily on the balance sheet, you won't see it. It will not be there, right? When you take the assets are properties, right? When you take the assets of the firm, you won't see that value they have, right? All you will see is furniture. Maybe the two firms, they both have three pieces of furniture. That's it, assuming, right? You won't see the value that Bella has compared to Kofi & Co., right? So that intrinsic value, inherent in the firm, for purposes of emanating from the quality of work they deliver or the reputation they have, the quality of goods, the quality of service, the excellence they demonstrate, is what we call goodwill, right? A lot of the books will say goodwill, you can't define it. It's difficult to define. We can only describe it to say what it is. That's what the books will tell you. And it's true, because it's not something that lends itself to easy definition, but you can easily, if you see it, it's like when you see it, you will see it. If you see goodwill, you will see it, right? Like two persons, you can put two individuals up. Let's say if the two of them have a firm, okay, and then both, let's say there are two candidates, they want to hire, right? They want to hire, and let's say I'm applying for the position, and let's say Mr. Chikata, the learned Mr. Chikata is also applying. What do you think? Right? There's some intrinsic value in Mr. Chikata that will make them, because they know that once they hire Mr. Chikata into their firm, the value of their firm will shoot up, whether you like it or not. Okay? So that intrinsic value is what we call goodwill. Now, let me bring it home. Assuming Mr. Chikata, Cindy, and our senior man are in partnership, as of today, and Mr. Chikata decides that he's going to go on retirement, he's resigning, he's retiring. The assets in the firm today on the balance sheet is worth 20,000 cedis. Do you think that it will be fair that they should just say the assets on the balance sheet is 20,000? So let's share the 20,000 into 3 and let's give Mr. Chikata 1 to go home with because he's retiring. Do you think it's fair? I don't think so. I don't think so because he is part of the firm has created a certain value that we need to find and we need to compensate him for that value he has created before he leaves. If you take Bella, same. The partners there, at 4 or 5 of them. If any of them is to be resigning now, there is some value that has been created by all of them together that makes Bella. And so we need to look for it. We need to then calculate it. We need to then share that value amongst the partners before the one resigning leaves. Okay? So normally you don't have to bother yourself with goodwill until such time that a partner is either being admitted or a partner is resigning, or there is a change in the profit and loss sharing ratio, or they want to sell the business, or they want to acquire the business. So what I'm saying is that unless something significant happens that will change the interest that each of the partners have in the firm, there's no need to value goodwill. And I've seen this also in the questions where they ask you, and first of all, they will ask what is goodwill, which of course you would describe, and then they ask to give some of the circumstances under which goodwill will be valued, or they will ask you to say, what are some of the circumstances that will give rise to a company having to value goodwill and recognize it in the books? If that happens, of course, we've dealt with the description or the definition of goodwill. The other 5 instances are, I'm saying, 1, when a partner is resigning, we need to value goodwill, and we know why, right? Because that partner has contributed in the creation of the value, that intrinsic value, and we need to compensate that partner upon resignation or upon whatever exit. When we admit a new partner, of course, we have created some value if you want to come and join us, let's find that value. Let's share it amongst us first. And then you can now come. Okay, so upon admission of a new partner, right? And then upon the change in the profit and loss sharing ratio. So let's say these two people are in partnership, sharing profit equally. 5 years down the line, they decide to vary their profit and loss sharing ratio. Let's say now it's going to be 70-30. Must they just change it and continue like that? No. The one who used to have 50 will say, oh, hang on. But whilst I had 50%, I contributed to some value. So let's find that value. Let's share 50-50, and then we can now change the sharing ratio. Are we okay? And then upon a merger, for example. So firm A decides to merge with firm B. Okay, what's going to happen? Firm A will say, look, we have some intrinsic value we've created. Same applies to firm B. So each of them will value whatever that goodwill is. They will share it among the partners before the merger happens. Okay, so those are some of the examples. Then revaluation. Okay, now revaluation has to do with, up until now, you will notice that accounting deals with historical values. Okay, so whatever we record, once we purchase, let's say 10 years ago, we purchased land at the price of 100,000 cedis at East Legon, or maybe even 20 years ago, let's say 30 years ago. I think 100,000 cedis 30 years ago in East Legon is fair, right? So we record debit land, 100,000, credit cash or bank, 100,000. So when you go onto the accounting books today, the land you will see is how much? 100,000. Every year it's that 100,000 that will stay on the books. Nothing more, nothing less. Fast forward 30 years today. Truth be told, is that land 100,000? No. But on the accounting books, it's 100,000. If a partner decides to resign today, what do? Do we say, okay, the land is 100,000. There are two of us, so 50,000 is yours. Get your 50,000 and go. No, all hell will break loose. So for such a reason, we will have to revalue. We have to do what we call revaluation of all assets and liabilities to establish what the true value of those assets are. Okay, so that we can compensate whichever partner is leaving. Or if a new partner is coming, we can share the increase in value before we admit the new partner. Okay, so revaluation and goodwill have the same concept. Okay, so if the question is asked, under what circumstances would a firm carry out revaluation of assets? We can talk of admission of partners, resignation of partners. We can talk of business acquisition, mergers, change in the profit and loss sharing ratio. Yeah, can talk about all that. Yeah? Okay. I think we've covered enough grounds. Now, let's tend to look at a question. Let's start with the most basic ones, right? Okay. So, question, do we have our manuals? No? Okay, let me try and see if I can put this online. So that's okay. Let me take a picture and put on the page. Everybody's on the accounting clinic page, right? Okay. So there will be 2 pages. Please. Okay, all right. So, sorry. This one, I don't think what I. Okay. Okay. 114. Okay. It says 114 to 115. So it's, I'm going to read it, right? It says Adoma, Bansa, and Car are in partnership of ABC firm, sharing profits and losses in the ratio of 2:2:1, respectively. Partners are credited with interest on capital at the rate of 5% and charged interest on drawings also at the rate of 5% per annum. The partners are entitled to annual salaries as follows. So now it says John 80,000. I think there's a mistake there. So if you have your manual, you may correct it, because remember he started by saying that Adoma, Bansa, and Car are in partnership. Now he's telling us that the partners are entitled to annual salaries as follows, and then he's mentioning different names. Okay. Okay, so it looks like I have an older version. Okay, so yours says what? Adoma. Okay, so Adoma has how much? 80,000. Okay, so it's been correct. So Adoma is 80,000. Bansa is that's correct. 80,750. And then Bansa has 120,000. And then Car has 150,000. Okay, so it's been corrected in the current one. Okay. Their capital and current account balances are as follows. Adoma has 520,000. Bansa has 450,000. And Car has 650,000. Thank you. Thanks. Okay. So it gives us the current accounts, right? It gives us the capital account. Now it gives us the current account. It says the current account at Doma is 35,000. Bansa is 40,000 and Car is 50,000. Drawings during the year were as follows. So Adoma is 20,000. Bansa is 40,000. And then Car is 60,000. It goes on to say that the net profit for the year before appropriation was 1.2 million. Now, the requirement of the question is this. You are required to prepare the profit and loss appropriation and current account of the partners for the year ended 31 December 2015. So take note. It's the profit and loss appropriation account and the current accounts, right? So he's not interested in the capital account. He's not asked us to prepare the capital account. But for our purposes, I will prepare it, okay? And revaluation and goodwill, we haven't gotten there yet. So those have not been brought in, okay? So now, few things to take note of. And this is where the tricks come from, okay? This is where the tricks come from. And the examiners like doing that a lot. I've seen it multiple times in the past question. So remember that when you borrow money, the interest is a per annum, okay? So if you borrow money from a bank and they charge you 10% interest, they will say 10% per annum. So if you borrow the money on 1st July 2024, and the interest, let's say you borrow 100,000, and you borrowed it 1st July 2024, you don't expect the bank to charge you an interest of 10% times 100,000, meaning 10,000. You don't expect them to charge you 10,000 as interest. Otherwise, they've cheated you. Because the 10% is per annum. Okay, let me explain. So, date of borrowing, 1st July 2023. You borrowed 100,000. Interest is 10% per annum. Yeah? I'm saying for the year 2023, I do not expect the interest charged by the bank to be 10,000. The bank should not just say 10% of 100,000 and charge me 10,000. I won't agree. If the bank does this, I will not agree. Why? Why? Because the interest is for the whole year. I did not borrow the money for the whole year of 2023. I borrowed the money 1st July. So as far as 2023 is concerned, I borrowed the money for only 6 months. So he must charge me interest for 6 months, not 1 year. Do we agree? So I expect the interest should then be times half or times 6/12. Do we agree? So the interest should be 5,000 as far as the year 2023 is concerned. And you will see this a lot. The partner will come and withdraw money from the firm, not at the commencement of the accounting year. It will be somewhere in the middle of the year. Okay? And when they do that, you should not be charging the partner interest on drawing for the entire year. Because when you do that, you're cheating the partner. So you must check and say, for how long did he borrow for this particular year we are talking about? So let's go back to this particular question and let's see what's happening, right? The drawings. The drawings is, you can equate the drawings to the borrowing, right? When were the drawings done? So we are, first of all, look at the question. It says we must prepare this account for the year ended what? 31st December 2015. Meaning the year starts from when? 1st January 2015 and it goes to 31st December 2015. Right? That's the year. Now, look at the drawings. The drawings are like borrowings by the partners. They came to take money from the firm, right? Adoma withdrew his on what? 1st January, right? Are we on the same page? The drawings done by Adoma was done on the 1st of January. But look at that of Bansa and Carl. Bansa's drawing was done on the 1st of July, whereas Carl's was on the 1st of October. Are we on the same page? So let's do the math. Let's work all the numbers so that we have our numbers ready before we start to prepare the account, right? And please, these workings please don't do them on your question paper and take them away. You'll lose marks big time. So have a header called workings and do these workings inside there so the examiner sees you have done it, right? Even if you do all the workings and you are unable to finish, you will get marks for the workings because the examiner says that you know the stuff. Okay, if you do them on your question paper, you will lose marks. So have a header called workings, nicely like this. So you can dedicate like 2 pages, right? It's up to you, but 2 pages, 3 pages. I mean, the answer scripts are ours. It will give us as many as we want. Okay, so I'm going to be calculating interest on drawings, okay? So computation of interest on drawings. Okay, then I'll start with the first partner. Who is the first partner? Adoma. Yeah? Adoma. Okay. Adoma borrowed what? Or withdrew how much?
20,000.
Okay, so Adoma withdrew 20,000. So his interest on drawings, interest will be equal to 5%. Is that not it?
Yes.
Of how much? 20,000. 20,000. But this must be for 12 months out of 12. Do you agree? Because she withdrew on 1st January and never paid back. So for the whole year. Are we on the same page? What would this give us? This will give us 10,000. Is that not? Oh, no, 1,000. Yeah? This whole thing goes to 1, right? 12 over 12 is 1. So this will give us 1,000. Are we on the same page? Anybody lost? We good? Okay. Who is the next partner? Bansa. Okay. Interest on drawings. Still 5%, right?
Yes.
Of what? How much did Bansa withdraw? 40,000. Okay. But was it for the whole year? Did she read? Okay, it wasn't for the whole year, right? So Bansa made the withdrawal 1st July. Somebody says for 7 months. Do you agree? Okay. How many months? 6 months. 1st July to 31st December is 6 months. July. Guys, I have found myself counting my figures in every time. And I do it without shame. It's easier. July, August, September, October, November, December. 6 months.
You see why I said 7? Because July was the 7th month.
Exactly. You can get tricked there. So it's 6 months. July, August, September, October, November, December. Exactly. I'll come to that. We'll come to that. The examiner can make it more interesting. Okay. So we all agree that it is 6 months out of 12. Right? Okay. So we must calculate 5% of 40 and then divide by 2. Because 6 of 12 is the same as 1 over 2, half. So whatever interest you get, you must find half of it. Do we follow? Yeah? Somebody do the maths for us. What do we get? 1,000. Okay. Is everybody getting 1,000? Yeah? Now let's go to the next partner, car. Sorry. Car's interest will also be 5%. How much did he borrow? 60,000. 60,000. And for how long? Was it for the whole year?
1st October.
So 1st October, November, December. So 3 months. He borrowed only for 3 months. So he must be charged interest only for 3 months, right? So times 3 out of 12. That's a quarter, yes. Yeah? Do we follow? What do we get? 750 cedis or dollars, whatever it is. Okay. Okay. Now, she asked a very important question, and I've seen this many times. Normally, the examiners are not that wicked. They will not put it in the middle. Normally, they will put it at the end. So, Bansa could have been 31 July. Bansa could have borrowed on 31 July, meaning you will not count July. You will start from August, September, October, November, December. Then it's 5 months out of 12. But if the examiner decides to be that wicked and puts it 15th July, then please, of course, or 15th July, then that is 6.5 months. 6.5 over 12. So that's what it is. Look, you can borrow. The reality of life is that you can borrow anytime you like, right? There's nothing prohibiting you from borrowing on the 3rd, on the 4th, on the 5th, on the 6th. You can borrow any day, any time. Okay, but I'm saying, I'm yet to see them. They may do that in CA, professional CA, but not here. Here, the worst they will do, in my view, is they will put it at the end of the month to trick you. So that if you are not careful, the thing is 31 July and you are counting July, then you are out. Because if it's borrowed on 31 July, you must not count July. You must start your counting from August. So we have, so this, please, like I'm saying, this, don't bring this home. Leave this in your answer booklet. It's part of the maths. Now, having calculated the interest on drawings, let's also calculate the interest on capital, because we were told that the partners are entitled to interest on capital, right? So let's do that. So I'll say computation of interest on capital. Okay. Start with the first partner, Adoma. Okay. Now, here the trick cannot be calculated, because remember, they were all in partnership. Partnership has been in existence from a couple of years back. So the capital they all contributed was in existence at the beginning of this financial year. Do you agree with me? So we don't have to do a lot of thinking here. Okay? All of them will earn interest on their capital for the full year. Why? Reason being that I'm saying they had been in the partnership from prior years. So the capital they contributed was contributed from inception. So as far as this financial year is concerned, the capital will be in existence at the beginning of the year. So the interest that each of them is entitled to must be for the entire year. Happiness? Okay, I should say it again. Okay, let's go back to the question. It says Adoma, Bansa, and Ka are in partnership. They are in partnership, sharing profit and losses on a certain ratio. So he has told us that these guys are already in partnership. Okay? Somewhere down the line, he tells us and says that he gives us the capital, right? He said if the capital balances. He gives us the capital balances, right? So what does that suggest? It means these are balances at the start. Okay, he didn't say that they only put this capital in this year. These are balances of their capital. So what I'm saying is that, first of all, the partnership firm has been in existence for some time, correct? Second, he has given us the partners' capital balances, correct? We are in 2015, and he has given us the balances for 2015, meaning at the start of 2015, these are the balances. So I'm saying it means that the capital has been in the business from the beginning of 2015 up to the end of 2015. So the interest to be paid on the capital must be for the entire 12 months. So we don't have to worry ourselves with this sort of arithmetics that we were doing as far as the interest on drawing is concerned. Are we okay? All right. So when we take the first partner, we have 520,000 or interest on capital. And this was 5%, he said, right? Times 520,000. Which will be what? 26,000. Okay? So here we don't have to worry because the capital was there for 12 months. Okay? Then for Adoma. Oh, sorry. Bansa. For Bansa, the interest on capital will be 5%. How much capital does
450,000.
450,000? So that will give us 22,500. Okay? And then CAR, interest on capital, will be equal to 5% of how much capital does CAR? 650,000. Which would then be 32,500. Now, let me hasten to add here, and I hope we come to a question that will have that. Remember that these capital contributions of the three partners has been in the firm at the inception of 2015. Okay? It is possible that somewhere in the question, the examiner will say that during the year, the partners introduce further capital. Are you with me? And that Adoma on 1st July 2015 introduced 10,000 additional capital. Bansa, 1st October, introduced X amount of capital. CAR, 1st November, introduced Y amount of capital. If that happens, the interest calculation must be done in 2 steps. The first step is what we have done, which is the one that the capital that was there at the beginning. We calculate it like this. Then we must calculate another one on the additional capital they introduced. Because you see, if we add the 2 numbers, we will be wrong. Because if you add the 2 numbers, you can't say you will do for the full year or you will do for 6 months. So you must do it in 2 steps. The first step is what we have done. Then the second step, you then take the additional capital introduction. You do for all of them. So you now take Adoma additional capital introduction. If it was done on 1st July, it means we'll give him 5% on that amount he introduced times what? Half. Do we follow? Okay. Let me explain again. So this question is pretty straightforward. The partners had the capital at inception, and they've not added anything to it as far as this question is concerned. So what we have done now is good. We're good to go. Are we okay? But I'm trying to say that in some other instances, and life is like that, right? Life is not straightforward. In the real life, the partners at some point in time may need to inject further capital into the business. Okay? So if the examiner says that apart from the opening balances of capital, the partners introduced additional capital during the year, and they introduced the capital in this form, he will tell us. He will say, Adoma on the 1st of July 2015 brought in an additional 100,000. Bansa on 1st October brought in additional 200,000. And then Carl, let's say he on 1st January brought in an additional 300,000. I'm saying the interest calculation on capital will be done in 2 steps. The first step is what we have done, which is just take the interest, multiply it by the capital at the beginning of the year. You will get the amount of interest you must give the partner. But you haven't finished with this partner, because if you stop here, this is not all the interest he's entitled to. There is more. He brought in further capital during the year. On 1st July, he brought an additional 100,000. So what we would have done is that for this same partner, we would then have 5% of 100,000 times 6 of 12, assuming he brought his on 1st July 2015. Do you understand? So we will calculate this number, which will be what? 5,000. Is that not it? This will be 5,000. Meaning that the total interest that this guy is entitled to is this plus this. And I'm saying don't just add the 2 and slap 5%, because if you do, what are you going to do? Are you going to then multiply by 6/12, or you'll be wrong? So you can't add the 2 to do it. You must do it in 2 steps. Do we follow? Okay. I hope we come to some example like that so that you appreciate it. Okay. So now we've calculated the interest on drawings. We've calculated the interest on capital. What else? I think those are the 2 calculations we must do. So now let's turn attention to solving the question, or providing the requirement of the question, right? It says we should do what? Profit and loss appropriation account. Can I clean the board? Okay. So now to answer the question, it says prepare. So now, and guys, it's important, right? Format is important. In fact, I mean, you are the last people I should be telling, right? Because the law school, they say format is everything. Rate of sermons, what, everything is format. Accounting too is format. So we start with the name of the firm at the top. It's important. And the award marks for this. You'll be surprised. The award marks for this. Okay, so the name of the firm is what? It didn't say, right? So we just say Adoma, Bansa, and Carden, right? But normally, yeah, if he didn't tell us, usually, in fact, in the previous manual, he did say. But here, I don't know why they didn't say. So if they didn't say, then we just say Adoma, Bansa, and Car Partnership. Okay? Now the requirement is that we do what? We prepare the profit and loss appropriation account. So profit and loss appropriation account, and it is for the year ended 31 December 2015. We good? Okay. Because the examiner's intention is to assess our knowledge on partnership, okay? So he's not bothering us with preparing trading profit and loss account, no. So he gives us, he prepares the trading profit and loss account himself and determines the profit and gives the profit to us. So we only continue from that point. Do you follow? So when you look at the question, he says, I'm sure he gave us a profit somewhere. He said the net profit for the year before appropriation was 1,200,000. Do you see it? Just before the requirement of the question. The line before the requirement of the question. He gives us a net profit. Okay? And that's what will happen typically in the partnership questions. He won't let us start from revenue, less cost of sales. And because that is, if he wants to do that, that is to assess us on sole trader or some other form of business, just to see if we know how to prepare it. But if you want to assess us on partnership, he will give us a profit before appropriation. Okay? And I mean, we know appropriation, right? Like when you think of stealing and the definition for stealing, like appropriating somebody's appropriating, like taking, because the profit is for the firm, it's not for the partners. And now we are coming to appropriate it to the partners. We come to share it so that it becomes their bona fide property. That's the thing. Sorry? No, well, it's like you can liken it rather to like dividend. like their dividend, more or less, if you want to. Right? So we will start with the profit that he has given us, right? But we know that that profit he has given us is not the final profit, because some people came to take money from the business and the business charged them an interest, right? So whatever the business charged the partners for coming to withdraw money from the firm is an income that should form part of the profit, okay? So what you need to remember is that the profit the examiner will give us is the profit in the profit and loss account. It is before any adjustments are made. Okay, so it is not the final profit as far as the partnership firm is concerned. Are we together? Okay. So we'll start with the profit as per the income statement. So we say, I'm going to have like 2 columns. Is it in CDs? Is it current? Okay. And one thing before I go on, actually, guys, don't stress, right? In an accounting question, sometimes they say, okay, profit or loss account, income statement, statement of financial performance. Me, I don't stress myself. I go and look at the requirement of the question. If the examiner says prepares income statement, that's what I'll write. Income statement for the year ended, and then I move on. If it says prepare statement of financial performance, it is there in the question. I'll copy statement of financial performance, and I write it for him, right? I don't like to confuse. I keep it simple. What the examiner asks is what I take, and that's what I do for him. So it says appropriation account, we write appropriation account. Yeah? Okay. So profit for the year, right? Profit before appropriation. That's what the examiner actually said. Before appropriation. Right? How much? 1.2. Are we together? 1.2 million. Profit before appropriation. So to this profit, we will add the interest charge on drawings. Question is why? Why are we adding interest on drawings to this profit? I want us to understand. I don't want us to just memorize the format. I want us to understand why. Yeah. They want to hear you. Okay, my question is, I'm saying we start with profit before appropriation. And I'm saying to this profit, we will add interest on drawings. And I'm saying that I don't just want us to memorize that we add interest on drawings. Let's understand why we are adding interest on drawings to this profit. And I'm asking anybody, yes?
Because the interest, the drawings was from the account. So the interest that will accrue should be for the company. That is why we are adding it to
100%, right? So the partners came to take money from the business. If that money had been in the business, we would have put it in our bank account. We would have gained an interest on it, which would have been an income for the firm, right? Because they came to take that money out of the firm, we will levy them with an interest. We will charge them an interest. That interest is for the firm. So let's add it to the profit the firm has made so that we can establish the total profit of the firm. Are we together? Is that here? We're together, right? Okay. So we'll say add interest on drawings. And we will then list the partners, right? Who are the partners? Adoma. And then there is Bansa. And then there is Car. Okay. How much is the interest we are charging Adoma? 1,000. And that of Bansa? 1,000. And Car? 750. So you see what I've done, right? Just for format and just to be orderly in my presentation, I decided to use the second column to add all the interest together so that I'll get a total interest, and I come and put it here and then add it to this one, right? So that's 2,750. Is that not it? 2,750. So when I add to this, that will be 1,200,000. Hey, please use your calculator. 1,200,000 and 202,750. Yes. We're good. Are we following? So this is the profit, right? Okay. Now this profit is going to be appropriated. The appropriation is in 2 stages. The first stage is to pay the partners whatever salary we have agreed on. Okay? We'll pay them that salary out of this. Remember when we started, I said, according to section 35 of Act 152, the salaries of the partners is not supposed to be treated as an expense in the income statement. So in the examiner determining this profit, he did not treat the salaries of the partners as an expense. Are we together? Okay. So now we must deal with that salary here. Okay. So we'll say less salaries.
So what does that make? Those profits, right?
So this one. Yes, this is profit after adding interest on drawings. You don't need to. You don't need to. Yeah. You can say profit after adding interest on drawing, but you don't need to. You give it the marks anyway. In fact, all the accounting books will not label it. So now, with appropriation, we start with salaries, right? We good? Okay. So the salaries, all 3 partners were paid salaries, were they? Okay. So please give me the numbers. We have Adoma. How much?
80,750.
Okay, 80,750. And then for Bansa, 180. Okay, 120,000. And then for car, 150,000. Okay. What is the next thing we need to appropriate? Interest on capital. Interest on capital. So remember, after establishing the true profit, we are distributing the profit. The distribution of the profit is actually in stages. There is salaries to be paid to the partners, which is what we have written here. There is interest to be paid on the capital contribution by the partners, right? Because remember, the partners could have just decided, you know what, everybody should bring only 2 CDs as capital. The rest of the money we need, let's go to the bank and borrow. If we did that, we would have been paying interest to the bank, right? But now they brought their own money to run their business. So we need to pay them an interest on that money they brought, which we have calculated. So that money will go out of the profit, okay? It's an appropriation. It's a way of sharing profit, okay? Because remember, we will not be paying that interest if the business was not profitable. A lot of the time, that's what the partners will agree, right? We'll pay when now the business is profitable, so we'll pay, right? So we'll take, can I clean and go up, right? I can clean the top here. I should clean this side. Okay. All right. So I'm going to be continuing here, right? So I'll have two columns. I have this column and I have that column. So now I'm going to say interest on capital. So I'll have Adoma, I'll have Bansa, and I'll have Car, right? We've already done the calculation, so now we don't need to worry. We just have to pick the numbers. We've done all the work already. We did the computation of the interest on capital for all of them. What did we get for Adoma? 26,000. What about Bansa? 22,500. And then Car? 32,500. We good? Yes.
The interest on capital, are we adding or we are?
So we are deducting. So right now we are distributing the profit. So we had this profit, we charged all the partners some interest, and we added to this profit. So this is the money we have right now that we need to share. But we will not share this money straight away according to the profit sharing ratio. As the sharing is in stages, people will get their salaries. So we'll take the salaries out of this. Then people will get interest on the capital they gave the business. We'll also take it out of this. What is left is what we will now share according to the profit and loss sharing ratio. Do we follow? Okay. So, and that's why I didn't bother my head to kind of add here, because I'm going to add this to this, get the total, and take it out of this. Because anyway, I'm going to take this out, and I'm going to take that out as well. Right? So I can just add all of them, and then just come and put it here and take it out to get what the profit that is left is, so that I can share according to that profit and loss sharing ratio. Okay? All right. So when you add, and if you like, this one, there's no one fixed format. Somebody can say, let me add this and get a total. It's fine, except that it doesn't change your life much. Okay? So when you add everything, what do we get? And I'm coming to put it here because I want to take it out of this number. What do we get? 350,000.
No.
451,000.
Okay. I'm depending on you.
This one is 350, 750. But you add these ones.
There's this ones too. Yes, because we are going to deduct this and we will deduct. So we will just add in everything so that we will deduct. No, give me everything so that we have it once and for all. 431,750. Everybody has the same? We're on the same page. Take this. We can see how much profit is left in the profit and loss sharing ratio. Because in actual fact, this is also a way of sharing, actually, right? This is also a way of sharing. But the sharing in proportion to the profit and loss sharing ratio will be the final number that we will get after we take this out of that number. What do we get? 771,000. Okay. So you can just do this. There are two ways actually, but me, I like this one. I close this. Then now I come, I say share of profit. So they are coming to share this. And the people who will share are Adoma, Bansa, and Car. And they will share this. And again, you must show this in your workings, right? Or unless you want to do the workings here, But typically, I like to do it in my workings column, right? Now, the examiner says that the profit, the guys, they share profit or loss in 2-1. 2:2:1 respectively, right? So once it says respectively, it means the first name he mentions will take the first two. The second name will take the second ratio. And the last name will take the last ratio, right? So it means the ratio for sharing, this guy is 2, this guy is 2, and this guy is 1. Do we agree? Okay. What is the total? It means there's a total of 5. Right? Whatever profit they get, they will divide it into 5. This guy will take 2 of it, this guy will take 2 of it, and this guy will take 1 of it. Do we agree? Okay. So it therefore means that Adoma will get 2 out of 5 by 771,000. Bansa will get 2 out of 5 times 771,000. And then Carl will get 1.
Adoma gets 308.
I'll come to you. Okay. All right. So let me take some 3 minutes to explain ratios, okay, and how we calculate ratios so that everybody is on the same page. So when you are told that Kofi and Amma are sharing something, and they are sharing it in the ratio 2:1. Okay. What you should do, it doesn't matter how many people. If there are 10 people and they give you this is to that, is to that, is to that, what it means is that the summation of the ratios is how many parts the total must be divided into. Okay, so what it means is that under this circumstance, the total of the ratios is 3. So it means whatever they are sharing must be divided into 3. And then Kofi will take 2 of the 3. And then Amma will take 1 of the 3. Do we get it? If the ratio is 1:5:8, it means the item is being divided into what? 14 parts. Okay, you must just add the total, right? It means the item is being divided into 14 parts. The first person will take 1 out of 14. The other guy will take 5 out of 14. And this guy will take 8 out of 14. So back to our question. Because we were told it is 2:1. The total then is 5. 2 plus 2 plus 1 is 5. So they are dividing the whole profit into 5 portions. And then the first guy will take 2 portions, the other guy will take 2 portions, and the last guy will take 1 portion. And that is why we landed with 2 out of 5. And then 2 out of 5 and 1 out of 5. Yeah. Okay. So somebody do the math for us. What do we get for Adoma? 308,400. This guy will also get the same. 154,200. So this must equal to that. Okay. That ends appropriation account. So again, back to the requirement of the question. It says we have to prepare the appropriation account and the current account. And the current account. So the next thing is to do the current account. Are we okay? Can I clean here? I'd say that partnership is one of the cool areas that you can easily get a lot of marks, especially when the examiner decides to mix the theory with the calculation. you can score 25 over 25. Okay. Now, the concept of current account and capital account, if you understand it like this, right? And once you understand it, it's very easy. Both the capital account and the current account are for the partners. They are a representation of the partners. That's point one. Okay? The capital account is used to record capital remitted to the business by the partner. And that's it, only capital, especially speaking under fixed capital method. When the partners remit capital to the business, we record it in the capital account. And just like the sole proprietorship, your capital account will, well, more often than not be credited because the partners are given. And under the double entry rule, we know that what? You credit the giver. And the capital account represents the partner. So if the partner gives, we must be crediting the capital account. Happiness? We're on the same page, right? In the same vein, the current account also represents the partner. Okay, so it's very easy to also understand the current account. The current account also represents the partner. Now, what we do in the current account is that we use the current account to record all transactions apart from capital between the partner and the firm. So what am I talking about? If the partner comes to withdraw money, we will record it in the current account. If we charge him an interest for the money he comes to withdraw, we will record it in the capital account. If we pay him salary, we will record it in the current account, right? If he gets an interest on the capital, we will put it in the current account. If we share residual profit, we will put it in the current account. Okay? So all other things, all other dealings between the firm and the partner are recorded in the current account, except when he gives capital that we put in the capital account. Happiness?
Is that when he gets interest?
Interest on capital, we will record it in the current account. Everything, any relationship, any transaction between partner and firm should go to current account. The only exception is capital. When he introduces capital, we put it in the capital account. So your capital account, more often than not, will be clean because it will only have capital in it. And that is the reason why he didn't bother to ask us to prepare capital account, because what will be in it? Only one line item, capital, the opening balance. That's the only thing that will be in it. That's why he didn't ask us to prepare capital account. It's of no use to him. But all other things are in the current account. The only reason he will ask you to prepare capital account, and the only reason there will be movements in the capital account, is when you have a fluctuating capital account method, in which case he doesn't keep the current account. You combine the current account and the capital account in one account called capital account. Then he will ask you to prepare capital account because he knows that it is a fluctuating method and you will have transactions in there. Do we follow? Okay. Sorry?
I think she's confused.
Okay. Let me, I'm not in a hurry to finish, right? The essence we are here is to understand. So please, if you don't understand.
Start from where you said that any dealings between the partner and the firm
Yes.
goes into the current account.
Okay. All right. So remember when we started, I said there are two methods for keeping the capital account. There are two methods. And I said one method is the fixed capital method, account method. And the other method is the fluctuating capital account method. We follow up to this point. Then I said, let's take them one by one. Under the fixed capital method, I said you have two types of accounts that will be prepared. You have the capital account and you have the current account. Then I said that the capital account you have will only record capital. That's all. So that account will be clean. Only capital will be in there. Then the current account will be the account that will be burdened, because that will be the account we will use to record all transactions between the partner and the firm, excluding the capital, because we know that the capital is in the capital account. Do we understand up to this point? Then I turn to the fluctuating capital approach method, where I said the fluctuating method doesn't keep two separate accounts for capital and current account. It merges the two into one account, and they call that account capital account. What it therefore means is that that capital account will have a lot of things, debit, credit, because your current account has a lot of debit, credit, and now you have fused it into that current capital account. So automatically, your capital account now will have debit, credits in it. Do we follow? And that is why we also call it fluctuating, because at the end of the day, the balance you will have on that capital account will not be the same as you started. Whereas under the fixed capital account method, because there's a separate capital account and it only contains capital, that balance will be fixed. It will be fixed down until a new capital is introduced, which doesn't happen often. Partners don't introduce capital often, once in a while. So it will be fixed. Are we okay? We're good? Okay. So now that we're on the same page, let's prepare the current account, which is what the question has asked us to do. And let me say something. And please make a small note somewhere, something you must always remember, right? And that is, as long as there is interest on drawings, or maybe before I make that point, let me go back one step. You see the appropriation account that we did? Everything that we need to prepare the current account, we will pick from the appropriation account. Okay? Everything we need. The only exceptions are two. The opening balance of the current account. And that's obvious, right? The opening balance of the current account is not in the appropriation account. It's in the question. The examiner told us the opening balance. Okay? The other thing is drawings. And now to the point I want to make, and I said you should make a note. Always remember that the fact that there is interest on drawings means that there is drawings. I mean, it goes without saying, right? A partner cannot be charged interest on drawings if that partner had not made drawings. True? Yes. So the mere fact that there is interest on drawings in the appropriation account means that automatically there must be drawings. There is drawings. So when we get to the current account, even though you are picking things from the appropriation account to prepare your current account, don't forget that there is drawings, which is not in the appropriation account, and you need to pick it and you need to use it in your current account. A lot of people do forget. Okay, I'll go over again. The opening balance. So what I'm saying is that the first point I made is that everything we need to prepare the current account, we will find in the appropriation account that we have just finished. So it's so easy. In fact, that's why partnership is so easy. Okay, we don't have to do a lot of thinking. With a few tricks about the interest calculation that you must watch out for the dates and all that. It's so straightforward. Okay? Everything we need to prepare the appropriation account, to prepare the current account, we will pick from the appropriation account. And then I said, of course, to every rule there's a few exceptions, right? Now I'm saying there are two exceptions here. The first one being the opening balance of the current account. So sometimes there may be opening balance on the current account. Sometimes there may not be opening balance. If there's an opening balance, it will be in the question. So we'll pick it from the question itself. If there's no opening balance, well and good. We progress. Are we good? Are we good? Then the second thing I'm saying is that once you, in your appropriation account, you see interest on drawings, be minded or be remembered that, remember that it means there's drawings. Logically, there's drawings. It's the only reason why there will be interest on drawings. So whilst you are busy picking the things from the appropriation account, remember that the drawings itself is not in the appropriation account. You must pick it from the question. Okay? Apart from these two, we are good. Everything else, we will get 100%. So let's start. So we've got Bansa. Adoma rather first. Yeah. Adoma, Bansa, and Car partnership. Yes. No, the current account is as at 31 December 2015. Now, let me explain one thing. And you can choose which one you like because they are both correct, except that one method is preferred. You can do Adoma, you can do Bansa, and you can do Car. They are current accounts. Each of them, they are current accounts. You can do like this, okay? You can do this. However, the examiners prefer the current account all done in one, in the columnar form. Okay, so we're going to fuse the three together as one T and have columns for each of the partners. Do you get it? But if you do it like this, you are not wrong. If you do it like this, you are not wrong. But I'm just saying there's a preferred way of doing it, where they rather do it in the columnar form. Okay? So it's a T, it's an account. Okay, just that normal account we know. So it's a T, right? Like this. But remember, it could be Adoma, in which case there'll be a debit side for Adoma and there'll be a credit side for Adoma. Is that not it? And it could be Bansa. Bansa to have his account a debit side and a credit side. And it could be Car. Car to have a debit side and a credit side. Do we agree? So for that reason, on the debit side, they must all have their debit sides, which is Adoma, Bansa, Car. They all have their debit, and they must all have their credit. Adoma, Bansa, and Car. Put your currency sign nicely. Are we on the same page? We good? You don't need to. Okay, if you want to, in fact, you are not prohibited from doing it. Somebody is asking whether she can rule lines in between. And I'm saying if she wants to, it's fine. But just that normally I will caution that when you do that, then you must double this line to show the separation of the debit from the credit. But usually I like to just keep it like this without the lines. Okay. Every account we know. Okay. Let's give ourselves a few minutes and see if the generator kicks in. Okay. Okay. So I was about making the point that every account, especially balance sheet accounts, okay, or assets and liability accounts, usually will start with an opening balance. There will be some balance at the start of the year because this is a going concern. This is a business that has been in operation. This is not the first time we are starting the business, right? So because the business has been ongoing, it's more likely than not that there will be some balance on the account. So watch out for it. And this is the exception I talked about, the first exception. Remember, I said we'll pick everything from the appropriation account, except what? The opening balance and the drawings, which I said you must not forget, right? So according to the question, what are the opening balances of the partners? And I'll sound a note of caution here. Don't be deceived into thinking that once the first guy's balance is a credit, all of them is a credit. The examiner can give you a mix where Adomen's opening balance is credit, Banser's opening balance is debit. So watch out. Okay? And the examiner will tell you, this one is not for you to go and think and figure it out. The examiner will tell you bluntly. It will be there on the paper. So, for example, here, the assumption, if he doesn't tell us, is that they are credit. Why? Why? Because usually we will owe the partners. Usually. The firm will owe the partners. Usually. We don't allow the partners to owe the firm. Otherwise, it means they have taken too much money out and we cannot run the firm. You get it? So usually, either the balance is zero or the partnership firm rather owes the partner and is yet to pay the partner. So usually, the balance will be credit. It's a liability. As far as the partnership firm is concerned, they have a liability towards the partner, and that's why it will be credit. So if it is debit, the examiner will say so. Okay? So what does this particular question say? The current account. So you see, say the capital and current account balances are as follows. So it gives us a capital, which we are not interested in because it's not asked us to do a capital account. But when you go to the current account, it says Adoma and it just says 35,000. Bansa, 40,000. Car, 40,000. He has not said whether it is a debit or a credit. And I'm saying if he has not said it, it is credit. Because more often than not, it is the firm that will owe the partners and not the other way around. Are we on the same page? If one of them were debit, you would have seen him write DR by the side to signify that that particular balance is a debit, meaning that balance brought down should be here rather. But in this case, they will all be on the credit. We good? So we start. So this will be what date? Can somebody tell me? What day should I write here? What day should I write here? 1st January. That's correct. Should be 1st January 2015. Balance brought down or brought forward. It's the same thing. Sorry? The year ended 2015. Because the year starts, this is the opening balance. If you look at the header, we are preparing the account as at. So this is the end point. So we should have started from here. Okay. Okay. So somebody give me the figures. Adoma is how much? 35,000. And Bansa? 40,000. And car? 50,000. 60. 50, okay. Okay. So you see this one is simpler, right? If other than, unlike opening 3 accounts, if you had opened Adoma account, Bansa account, Carl account, we would have written balance brought down 3 times for all of them because they should all have their balance brought down, right? But if you do the 3 column, it's just one balance that we write for all of them. And that's why this is more preferred than where you open 3 different accounts. Okay. All right. So we've killed the first exception, right? So the second exception. Normally that's how I like to do my things, right? Because I know that everything else I will pick from the appropriation account. So when I'm dealing with the exception, I deal with the exception. So that when I go and start picking, I know that the rest I'll just pick from the appropriation and I'm done, right? So I'll deal with the second exception. And that second exception is what? Drawings, right? And also think about it. from a logical sequence point of view, drawings must be next. I can't deal with the salaries, I can't deal with the interest until I deal with the drawings. Why? Why? Because the salaries were paid 31st month. The appropriation, remember the appropriation? The appropriation was done at the end of the year when we had prepared the profit and loss account, established the profit, and did all those arithmetic, right? So the appropriation of salaries was done post 31st December. Do you agree with me? Okay. I'm saying that first we prepared the appropriation account, right? Now, in preparing the appropriation account, we took the profit that was made for the year. Remember, before that profit was established, or when was that profit established? It was established post 31st December. Wouldn't you agree? Because there's no way you can determine the profit of a company in the middle. The profit for the whole year cannot be determined in the middle of the year. It's not possible. That profit can only be established at the end of the year. You agree? Okay. So, working with only that assumption, I'm saying the drawings, according to the question, some happen in what? July. Some happen in October. And one happened when? January. So, I cannot be recording share of profit before recording the drawings. Otherwise, the dates, I'll be recording 31st December and I'll be recording 1st January at the bottom, which will not follow a good sequence. I don't know if you get what I mean. Your things that happen earlier in the year will be recorded first. Okay. So, drawings is what I'll record next. Okay. Now, the question I'll ask you is, and I want us to understand, because for me, when you understand, it's easier to remember. It's not just to memorize our drawings is here. No. The question I'll ask is, where should the drawings be and why? This is current account. Remember that in accounting, everything is double entry. We have been told that partners came to take money from the business. They came to draw money from the business. My question is, where should we record that drawings? Or what would accountant have done when the drawings happen? Think of your double entry. What would have happened? Debit what comes into the business, credit what goes out of the business. Debit the receiver, credit the giver. So what should we do as far as this drawing is concerned? We debit the current account because remember we have said that the current account is a representation of the dealing between the firm and the partner. So this is representing the partner. We gave money out. Money left the business. So we'll credit our bank account. When he came to take the money, we'll credit bank because money left the business. Debit the receiver. Who is the receiver? The partner. Because they are the receivers. So we'll debit them. Debit means the left-hand side of the T. And that is why drawings must be here and will always be here. Are we on the same page? Okay. So let's use the dates. So, and again here, so if you want to use the dates, then you must go on different lines because the drawings happen at different dates. You get my point? We cannot just use drawings and write all of them on the same line because then the question is, what date will we write? So, 1st January. 1st Jan, drawings. Adoma is 20,000. Then the next one happened 1st July.
1st July.
Drawings. Bansa.
40,000.
40,000. Then the next one was when?
1st October.
1st October. Drawings. How much? 60,000. Do we follow? I won't be surprised. The textbook, they could have just written drawings and they write all of them like that. If they did, then they must not write a date. Okay, so then that's problematic. Because we know that they happen on different dates. Are we good? The rest, we pick everything from the appropriation account. And And again, I want us to understand why we'll be putting, I will say, let's put this to the credit and let's put this to the debit. I want us to understand, because if we understand, it's easy. When you are by yourself, you can always remember the understanding and you can do it, right? So let's start. In the appropriation account, apart from the profit, what was the first thing we treated? Interest on drawings, right? So now let's do the analysis. Interest on drawings is a transaction, right? So what will we do if as a firm, you are the accountant of the firm, and the firm has earned interest on drawings? What entries will you pass?
It's an income.
It's an income, yes. It's an income to the firm. So you credit what account? Well, somebody says you credit the firm's account. Let's put that in there. Let's note it down. Okay. So somebody says credit the firm's account. And then you debit what? You debit what? So let's turn to our rules. The double entry rule. We say what? Debit the receiver, credit the giver. Or debit what comes into the business and credit what goes out. It's the same rule that I like to say it in two different ways, because sometimes when you stick to the first one, you get stuck. Because sometimes you don't see who is the giver and who is, you're not seeing it. But then when you tend to what comes in, then it becomes clearer to you, right? So debit the receiver, credit the giver, or debit what comes in. It's the same as receiver. What comes in and credit what goes out, right? So debit the receiver. Who is the receiver here? The firm. Okay, so the firm. So the firm. Okay, and who is the giver? The partners. Okay. Okay, so you see that, we will see why this is problematic, right? Because then all of a sudden this is not making sense to us. Right? Because first of all, we will not have anything called a firm account. And we will not have, well the partner, yes, we'll have the partner's account. But must we be crediting the partners? No. So that's where the problem is. So that you realize that if you stick to that rule, it doesn't work well. So let's turn to the other one. Debit what comes in, credit what goes out. Now, somebody said that the firm earn an income, right? So remember, we're talking the business, the firm. The firm charged somebody an interest. So somebody paid that interest, or somebody is to pay that interest, right? So it's like, let's turn to sales, right? If you sell, somebody must pay for that sales. Somebody receives it and must pay for that sales. And for you, you have earned an income. Do we agree? So if we charge somebody an interest as a firm, we have earned an income. True or false? So an income has been earned by the firm. True?
True.
Okay. We know from our double entry rule that income is a constant credit. True? What you need to remember is that this was not paid for. It's not like the partners gave us money and we received the money, we received the interest, and we went to deposit in our bank, for which reason you say debit bank and credit the partner. The partner never paid, right? So we cannot be crediting the partner. He never paid. He is rather indebted to the firm. Is anybody lost? Okay. What I'm saying is that don't confuse. There are two things. And you guys are the second part, and I'll explain, right? So the first thing is that interest, income, and is not the same as interest, income, received. You guys are here. You are thinking that the partner has paid us the interest. But that's not what the question says. It says we charged the interest. He hasn't paid the interest. If he paid, then debit bank, because we've received money, and credit the partner, credit the giver, which is here. The interest has been received. That's not the situation we have. We have this situation. The interest has been earned. It's like we have made sales on credit. When you make sales on credit, what do? You credit sales and you debit the debt, the person you sold to, because he owes you money. Are you with me? In this particular instance, we have earned the interest. We have calculated it and charged the partner, but he hasn't given us the money. So the partner must owe us for the interest we have charged him. Do you agree? Do we agree? The only way the partner will owe us is to debit him. Don't we agree? And the only way we can show that we have earned an income is to credit the income account, which is what we did in the appropriation account. We added the interest to the profit. So we credited the appropriation account. So we need to pass a corresponding debit by debiting the partner's current account. Do we follow? So that the partner will now owe us and we can collect our money. I'm happy to stay here. And as okay. When you let's take interest. Let's say a staff of the company borrowed money from the company. You know, a lot of companies have staff loan, right? So the company gives a loan to the company. The first entry we'll do is credit bank, because money went out of bank. And then debit the staff, because the staff has received the money, right? So the staff, into bracket, loan. So the staff owes us money. But that's not the end of the story. At the end of the year, maybe we charge 5% interest on the loan. That 5% interest, we must calculate it and do a double entry for it. Okay? So when we calculate the 5%, let's say we get 1,000 cedis. We have to do a double entry for that 1,000 cedis. And I'm saying that the staff hasn't paid the interest yet. He borrowed, let's say, 10,000. But apart from the 10,000 he owes, we are at the end of the year. He owes for an interest too. So when you look in the staff account, there must not be only 10,000. There must be 10,000 plus the interest. Do you agree with me? The only way to show 10,000 plus the interest is that I must debit him again with the interest. If the interest is 1,000, I must debit him. So the staff will have, let's say, staff loan. When I gave him the loan, I debited him 100,000. Are you with me on this? And then I credited my bank, because money went out of bank, 100,000. Do you agree with this? And this happened 1st January. Okay? This is the same as a partnership account. When the guy came to withdraw the money, I credited my bank. So money went out of the bank. And I debited him for drawings, which is what we talked about. You understand? So I passed this double entry. Are we on the same page? Fast forward, the year has ended. I'm saying, hey, hold on here. According to our partnership agreement, I must charge you an interest of 5%. Right? I'm just charging you 5%. So it means you should no longer owe me 100,000. There must be 5% inside. I must add to it. So what must I do? I must debit you. What is 5%? 5,000. I cannot. What must I credit? I must credit interest income, because I have earned an income. So I'll have interest income account, which I will credit 5,000. You agree up to this stage? You agree up to this stage? That's exactly what is happening. When he withdrew the money, we credited bank, and we debited the partners with their drawings. Now I'm saying the interest that we're charging them to, we must debit their account so that they owe us more. Because the partner do not only owe for the drawings, he also owes us for the interest on the drawings. He owes us two things. So I need to debit him again for the interest. The corresponding credit has already been passed. We passed it in the appropriation account. That was the interest we added to the profit. By adding it to the profit, it means you've credited the interest income account. Does it make sense now? Okay. So, and that's why interest on drawings will always be debit. Because we must increase the indebtedness of the partner. 1,000. Bansa is how much? 1,000. And then car is how much? 750. I mean, I could have just said interest of drawings is here, and then we move on. But then, for me, do we know why it's here? Why is debit, right? Okay. Then, again, like I said, we will pick everything else from the appropriation account. We've taken the interest. What about interest on capital? This is the reverse. Because we rather owe the partner for the interest on capital. It's not the partner owing us. So if we owe the partner, we must be recording it on the credit side. Do we follow? Okay. And the debit is in the appropriation account. That's why it's a deduction from the profit. It's like an expense. Your expenses are deductions from your profit. So if you look at the appropriation account, the interest on capital was deducted. Okay, so this is the other leg. Okay. So interest on capital. So this is 31 December, interest on capital. We good? How much? We've already calculated the numbers, right? Yes. How much do we have for Adoma? 26,000. Bansa? 22,500. And then car? 32,500. Do we follow? Okay. What's the next thing in the appropriation account? Salaries. Again. So what do you think? Where should salary? Credit. Yeah? Credit. And it makes sense to you, right? Because we owe the partner the salary. So we'll credit him. The corresponding debit is an expense. So that's why we deducted it from the profit in the appropriation account. Okay. So salary. How much for Adoma? 80,750. Bansa? 120,000. And then car? 150,000. Okay. What else is in the appropriation account? Share of profit. Where do you think it should be? Debit or credit? Credit. It's credit. Because we owe it to that share of profit. The firm must pay the partner that amount. We owe the partner that share of profit. So you can take it like this. Anything that the firm owes the partner is credit. Anything that the partner owes the firm is debit. Okay. So the last thing is share of profit, right? 31 December, share of profit. How much? When we calculate the share of profit, what did we? Oh, it's there. We have 308,400. We have 308,400. And then we have 154,200. We good? Okay. So having done this, we are actually done. All we need to do is to balance the account. So I'm going to clean this side, right? So we can balance off. You just have to balance off the account. That's all. Yeah? Let's balance off. And balancing off is very, very easy. Okay. I always advise that when you're balancing off an account, leave 2 spaces on both sides before you do your totals, right? So leave 2 spaces. Check. Okay, so 2 things. First of all, you must do the total on the same line, right? Don't do them on different lines, right? They must all be on the same line. So look at the side with most transactions, or the one that covers, the longer side, right? Which appears to be here, even though there are not many, right? Maybe because of the way I've written this. Here, it appears to be here. So I'll leave 2 spaces, and I'll make sure that those 2 spaces run through to the end, right? Then I will do my totals. And I'll explain why I do this. The reason I do this is because I don't know where the balance carried down is going to be. And I don't want to assume that it's going to be here and then do it only to start doing the math and realize it's here and I don't have space. So I leave enough space on both sides so that irrespective of where the balance carried down is, I'll still have space. Okay? So that's why I leave that space. And in which way the answer script is ours. We can ask for as many as we want. There'll be no problem. Now, in balancing off an account, what we are going to do is that, you see, these are 3 different accounts we've put together as one. So there's Adoma debit and Adoma credit, Bansa debit, Bansa credit, and car debit, car credit. So we will balance Adoma debit against Adoma credit. Okay? Now what you do is take Adoma debit, add everything there. Write it down somewhere. Take Adoma credit, add everything. The bigger of the 2 is what you should put down at both sides. Do we follow? Okay, so I'm saying leave enough space, okay? And in both columns, leave enough space because we don't know where the balance carried down is going to be. So make sure you leave enough space here and you leave enough space here. So we have space to write the balance carried down. After do your totals like I have done, right? Then I said, this is 3 in 1 account. There is Adoma account, there's Bansa account, and there's car account, okay? We will balance Adoma independent of Bansa and independent of car. Each person's account will be balanced independently, okay? So what I'm saying is that I'll start with the first person, Adoma. So I'll take Adoma debit and I'll take Adoma credit. Those are the only 2 columns I'm interested in right now because that is the one I'm going to be balancing. And I'm saying add everything under Adoma. You'll get some total. I don't know. Maybe by inspection, I can tell it is 21,000. Yeah? So Adoma, I'll write somewhere on my question paper, 21,000 on the left side. When I add Adoma on the credit side, obviously the credit side will be bigger. So add the credit side for me. Let's see what you get.
45, 150.
Oh, it must be 400 though, because this is
450,000.
okay. 450,000, 150. And then I'm saying after adding this, you add Adoma and Adoma. Compare the 2. Which one is bigger? Of course, this is bigger. I'm saying write the bigger one at both places. Okay? So I'm going to write 450, 150 here, and I'll write the same thing, 450, 150. Are we on the same page? Okay. Then the next thing I'll do, I'll say, but when I look here, this is okay, perfect. Because when I add here, I get 450, 150. So there's no problem. But I have a problem here. When I add this, I don't get 450, 150. So whatever is needed to make this 450, 150 is what you call your balance carry down. Okay? So you come here and you say balance carry down. So you just find what number it is that you need to put here to make this number 450. 429, 150. That's it. We have balance Adoma. On this basis, can we balance Bansa? Who can try balancing Bansa for us? With the same principle. That's how you balance accounts. So you check the two sides of Bansa. Which side is the bigger? The right side. So we must find that total and write it at both places. Okay, so what do you get? 490, 900. So we must write the same thing here. 490, 900. Obviously, this is perfect. It matches. But this doesn't. So what do we need to put here to make it also? 486, 800. Okay, somebody has a different number. 449.
How come? No.
Okay.
This is 4,000, 41,000.
This is 41,000. So you take 41,000 out of this. So it should be
499.
No, it should be 449. It should be 449. 449, 900. Yes. Something like this. Yeah. Yeah. Are we on the same page? Okay. Then we balance off car. We take car debit compared to car credit. And we sum both sides. And we take the bigger one and we put at both places. We good? And I'll encourage all of us to get our calculators now, please. One of the things about having a calculator that you are used to is it increases your speed because you get used to where the key parts are. So try to start using it now before the exams. Never go into an exam with a brand new calculator or a borrowed calculator unless it is the same calculator you have been using to learn. If it's, let's say, Casio FX82 and you had one and you've been using it to learn, and maybe getting to the exam, something happened, you lost it or whatever, and you go and borrow another Casio FX82, then it's fine because it's the same calculator, same keypads. But otherwise, I will encourage you to go into the exam room with a calculator that you are familiar with. It's very important. Anybody balancing car for us? The bigger side is the right side, right? So we'll write that total both. It's what? 386,700. We'll write the same here. 386,700. Obviously, here will be fine, but here will not. So what do we need to put here to make here fine? 325,950. So we've balanced the account. But remember, every balance carried down must be brought down. In fact, let me tell you this. The examiners sometimes typically will not award mark for this. They will rather award marks for the balance brought down, just to punish students. Because they know majority of people will forget to bring the balances down. So they will not award marks. It's the same numbers you write. So why should they award you marks twice? So they'll say, okay, let's award the mark for the balance brought down, because they know that's the one that most people will forget.
So that will be 1st January.
So exactly. So that will be 1st January
2016.
1st Jan 2016. You say balance brought forward or brought down. And you write the same numbers, right? So this will be 429,150. This will be 449,900, and this will be 325,950. Please don't forget this. Please, please, please.
Whoa.
Any questions? Are we good? So it's like 5 to 6. I wouldn't want to load you with too much.
No, it's enough for today.
I think you've had enough for one day. We will, God willing, take it. Okay, you have a question. Okay. Yes. And we did a lot of the theory also, right? So, in actual fact, I may want to take another question on this, but maybe with a fluctuating capital approach. So this is the fixed, sorry? Before we change. Okay. So no problem. But yeah, there are various variants, and I'll go step by step so we cover everything. Okay.
Yeah, I got it. Yeah, it's right on there.
Yes, boss.
I was so far, so after getting that calculation, then you bring this one down.
Yeah, so this is this one. The
The
same
The one that we balance, used to balance
on the other side, yes. You bring it down. Balance brought down. Yes. You just write under each of them.